Ignoring the real story behind this market crash could mean you sell at the absolute bottom, right before the next institutional wave hits. Now, while everyone's panicking about a so-called Ponzi scheme, an $11 trillion giant that once blocked Bitcoin is now quietly opening the floodgates. By the end of this, you'll see why the three biggest fears driving this dip are baseless, and you'll understand the one colossal signal that could define the entire next market cycle.
Okay, so what kicked all of this off? It all started at the beginning of the month with this sudden jolt to the system that honestly sent waves of panic across the entire market.
Bitcoin just plummeted, a sharp 7.5% drop in what people are now calling the Cyber Monday crash. This was one of the worst starts to a fourth quarter in its history, and it absolutely rattled investor confidence.
But here's the thing. Here's what the panic sellers totally missed. Despite that nasty drop, the broader uptrend, the big picture, it was still intact. Bitcoin actually printed a higher low. This looks a lot more like a capitulation event, basically a final shakeout of nervous investors, not a real trend reversal. So, if the charts were okay, what caused all the fear?
Well, according to some analysis from Crypto Global News, the drop was fueled by a perfect storm of what we call FUD, that's fear, uncertainty, and doubt, and it all seemed to hit the market at the exact same time.
Yeah, three totally separate stories popped up, and it really felt coordinated. Each one was perfectly designed to stir up the market. You had the unwinding of the yen carry trade, a sudden credit downgrade for Tether, and then some really serious accusations thrown at MicroStrategy.
But these pillars of panic, they really start to fall apart when you actually look at the data. So let's do that. Let's take apart each one of these fear narratives one by one.
First up, the fear around Japan's interest rates. This was all about the yen carry trade. That's where investors borrow super cheap Japanese yen to buy assets with higher returns, like crypto. The story was that a rate hike would force this huge crypto sell-off. But the reality? The data shows that about 75% of that leverage was already washed out of the system back in August. On top of that, the Bank of Japan is moving in these tiny quarter-point steps. It's just not the catastrophe it was made out to be.
All right, next up, the Tether downgrade. So S&P raised a red flag because Tether holds assets like Bitcoin and gold. But here's what's interesting. Critics are pointing out that the report seems to have conveniently ignored Tether's nearly $30 billion financial buffer. That's a huge cushion. So the key point here is that even in a major crash, their risk seems pretty minimal. A lot of people are seeing this as a tactic to pressure stablecoins into buying US debt instead.
And finally, the big one, the MicroStrategy Ponzi claim. That is a heavy accusation. The fear was that the company would be forced to sell its Bitcoin just to pay out its dividends. But right before this FUD storm hit, they went out and raised capital. They now have $1.44 billion in cash sitting on hand. That's enough to cover all their obligations for the next 2 years. It just completely neutralizes the whole forced selling argument.
So this brings us to what's really going on. Because while the entire market was distracted by all this manufactured FUD, a truly massive, monumental shift was happening, almost completely under the radar.
Remember this? Back at the start of 2024, Vanguard was probably the biggest crypto opponent out there. Their CEO famously blocked clients from buying Bitcoin ETFs, and they made this very public, very hardline stance against it.
And now, in a pretty stunning reversal, they're opening up their brokerage platform to Bitcoin, Ethereum, XRP, and Solana ETFs. This is a complete 180. So you have to ask, why the sudden change of heart?
Because you just can't ignore an $11 trillion asset manager changing its mind. This is not just some news headline. This is a seismic signal of a huge institutional capitulation. The last holdouts are finally giving in.
Look, they were facing incredible pressure. It wasn't just about losing some clients or missing out on ETF revenue. This became a fundamental business risk for them. By blocking access, they were basically telling an entire generation of investors, hey, our platform is obsolete. They had to give in, not just for profits, but for their own relevance in a market that was clearly moving forward without them.
So this is the really crucial point. This pivot from Vanguard, it signals way more than just one company changing its mind. It signals a brand new phase for the entire market. You could say the era of the market, depending on one man's company, what some people call the Saylor cycle, that might be ending. We are now entering a totally new phase, the institutional cycle. And this one isn't driven by a single corporate buyer, it's driven by broad access through the largest players in traditional finance.
This isn't about one company buying Bitcoin anymore. No, this is about opening the floodgates for millions of clients at the world's largest asset managers to finally get exposure, easily and safely, right from their existing accounts.
So, while so many people were panicking over manufactured fear, the real landscape-changing story was unfolding right in plain sight. The takeaway here is crystal clear. The FUD was just noise. It was a distraction, probably designed to shake you out. The real signal is that behind the scenes, a new, much more powerful institutional cycle is just getting started. The real question is, are you positioned for it?
Stay ahead in the crypto market. Subscribe now for the latest global news and updates.